Hello, everybody. Eddie Ardeni here. I'm recording this on September 6th, Wednesday, September 6th in the morning. My wife and I are going to get on a plane and go off to a vacation in Scandinavia. I'll have my laptop with me. So it's a working vacation. I guess my wife will be vacationing and I'll be working, but we'll have plenty of time to do some sightseeing. Anyways, as I think it was Peter, Paul, and Mary that sang the song "My Bags Are Packed and I'm Ready to Go." So I got my bags over there, and we're looking forward to a good time. Meanwhile, I hope we have a good time here in the markets. Though September is known to be a pretty rotten month for the stock market. It's a great month for apple picking, but sometimes those apples fall off the tree, and it looks like they should be worth picking up, but some of them could be rotten. So I don't want to, enough with the apple analogy, but you get what my drift here is. We have to think about what could go wrong in September, and it's really not that hard to come up with some issues that may weigh on the market in September, maybe linger into October, and then hopefully set us up for a year-end rally, Santa Claus rally. We're going to need it. But look, my view has been that there would be no recession this year. That was my view at the beginning of the year. It's been my view for really the beginning of last year. But as a result of that, I did think that the market bottomed on October 12th of last year, and I thought that this first half of this year would be a pretty good year for the market. It turned out to be better than I expected, because I've been predicting that the S&P 500 will get to 4,600 by the end of this year. Instead, we got there basically by the end of July of this year. I didn't raise my targets, kept them there, figuring that maybe the second half wouldn't be as splendid as the first half of the year. And we made it all right through the summer, but now we've got September and October ahead of us. And these months tend to be jinxed, and it's not too hard to figure out what could go wrong, as I mentioned. Well, let's look at a couple of things here. Share this publication here. This is the quick takes that I sent out Tuesday, September 5th, and it's titled "What Could Go Wrong in September." So I've got my script here for me. I don't have to juggle around too many things here, but the market through September 5th has we've had a bit of a sell-off here from this channel that I drew. I'm an amateur technician, so I drew a channel here for the bull market, and it's been channeling, and it got to the top here, kind of lingered around the top for a while. Looked like it might actually break out, but then it didn't. In August, we started to see the market coming down. And that had something to do, of course, with concerns about what Fed Chair Powell might say. And sure enough, at the end of the month, he turned out to be relatively hawkish. Bond yields moved above 4% at the end of July, and that got stock market jittery. So we dropped below the 50-day moving average. And then past few days, we've rallied back above it. But the past 2 days, so that'll be Tuesday and now Wednesday morning, we have the market basically retesting its 50-day moving average. So it's back down at this level. Where do we go next? Well, if September is going to be a bad month, and it's not always a bad month. It's bad since 1928. It's been bad 55% of the time. But this one, I think, could shape up to be a bad month. It's hard to see too much going for the bulls this month, and we'll get into that in a second. But where could we drop to? Well, the 200-day moving average is down here at roughly 4,200, let's say. So I think that's a possibility if we continue to do this channel. And if we get anywhere near that, then that could set us up for the year-end rally going back to 4,600. And then just to confirm that I think we're in a bull market, I'm predicting that we'll get to 5,400 next year. So I still don't see a recession, still see a risk of a recession, but still in the soft landing camp. And one of the main topics that I wrote about in the morning briefing for Wednesday, September 6th, is in fact that we are in a strong patch right now. The economy is actually looking quite strong. Real GDP is tracking at something like 5.6%. According to the Atlanta Fed's model, that'll be revised actually later today, September 6th. And then we got this morning the purchasing managers survey for services for non-manufacturing. And that was actually pretty strong. Slight uptick in the price indicator. We got the bond market jittery, which got the stock market jittery. So we could certainly see this thing break below the 50-day average and start to look like it's going to retest the bottom here. What might do it? Well, it's not too hard to come up with 7 problems that we face this month, maybe lingering into next month. One is the bond yield. It's back over 4.25%. So it looks as though that 4.25% peak of last year is not going to hold. I guess now that we're at 4.3%, we have to acknowledge the possibility of 4.5%. Some people talking 5%. I think that's a little bit extreme. 4.5% certainly is possible, and it's consistent with going back to a normal bond yield. In the past, prior to the great financial crisis, the years before that, we saw that the TIPS yield, the 10-year TIPS yield, was around 2%, and the inflation premium in the spread between the 10-year nominal and the 10-year TIPS was something like 2.5%. So that gives you 4.5% back to normal, if you will. So we've had this backup in the bond yield. We did see some decline recently in the economic surprise index, but now we may see that moving back up again as in reflecting, for example, the purchasing managers index being stronger than expected. So we'll see how that plays out. But another issue which has affected the bond market is the Saudis announced, I guess on September 5th, that they were going to keep their production cut of 1 million barrels per day, and that lifted the price. I think it's just maybe an acknowledgement by the Saudis that the Chinese economy is weak and demand for oil is weak. And maybe they're hoping that by keeping the supply down, China will revive, but that is still an open issue. I think the Chinese government is going to try to stimulate the economy, but it's going to be pretty hard. Their speculative bubble in property has burst, and it's not necessarily easy to put air into a bubble that's got holes in it. Meanwhile, on the good news front, oil production in the U.S. keeps going up to 12.8 million barrels per day, but the market right now is more focused on the Saudi announcement and perception that the Chinese government is going to try to stimulate. And if it succeeds, that'll increase oil demand. I don't think it's going to succeed. Another big issue is jitters over the March CPI. That'll come out next Wednesday, and or for you seeing this on Monday, it'll come out this on Wednesday. And you can see that we've got sort of a spread of opinions here. There's something called Trueflation on the internet, and they're tracking. They tracked inflation for the CPI at 2.5%. Cleveland Fed CPI tracker, however, is tracking more like, well, the headline is 3.8%. That's quite a bit higher than 2.5%. And even worse is that the core rate is at 4.5%. So that's going to keep everybody on jitters. And I'm not expecting any really happy surprise there. I'm expecting that, after 2 really good numbers, we may have a number that's not great, but not terrible either, allowing both sides of the reflation, disinflation argument to take their sides. We're still in the disinflation camp. The FOMC meets on September 19th and 20th, and obviously the CPI is going to influence what they do. If the CPI is bad, higher than expected, we can expect that they may very well increase the Fed funds by 25 basis points, and that Powell in his press conference will kind of reprise what he said at the hawkish Jackson Hole speech, which was that inflation remains too high, and the Fed has the Fed's job isn't done. Then we capped the month off with the United Auto Workers strike. Everybody's saying it's probably going to happen, and that could obviously, and this time they're going to strike against all three automakers. They're not just going to pick one, and that could depress the economy, and it could have an impact on car prices, raising car prices. Then again, can't get rid of this problem. Government shutdown. By the way, the same day we get the CPI on Wednesday, we're going to get the federal deficit, and that's not going to be a happy picture. I wish I could come up with something happy to tell you here, but there's a load of unpleasant news, let's say, shaping up here for the rest of September. The government shutdown is a possibility. The hardliners on the Republican side are playing a game of chicken with the Republican moderates and the Democrats, and it's not clear that the leadership in the House, McCarthy, is going to be able to pull off a hat trick on this one. I think the thinking is that if he gives the hardliners an impeachment against President Biden, then they'll moderate some of their demands here in the budgeting process. But I wouldn't bet too much money on that going well. And then, of course, there's China. This is the seventh issue, and we have uncertainty here. Is the Chinese government stimulus going to work and bring back some, keep commodity prices going up? Copper price doesn't really corroborate what we're seeing in the oil price so far, but we'll be watching that. If the stimulus doesn't work, then China will continue to be an important source of deflation for the global economy, and for us, that's a good thing. So that's the quick takes in case you missed it. Let me now switch gears, and I'll do a real quick run through of the morning briefing that I wrote for September 6th. Somewhere along the way in Scandinavia, I expect to be writing the morning briefing for Monday, and then Melissa and Jackie and Joe will be taking over for the rest of next week, so I can fill up with Danishes in Denmark and smoked salmon, I guess, throughout the area there. So real GDP growth has been in a soft landing. However, the third quarter looks like it's shaping up to be over 5%, but view that as a strong patch in a soft landing scenario. The outlook is still, I think, for the economy to grow, but a slower pace. I think consumer spending is going to slow. Some of that was boosted, particularly in July, by the Amazon Prime Day. There was a very strong number in June of this year, which made the level higher and set us up for a strong consumer in the third quarter. But I think there's going to be some slowing there. Student loans are about to resume in terms of people having to pay them on a monthly basis. And then there is this excess saving notion that consumers are going to be running out of it. I dispute that. I'm not buying it in full. I'm not rejecting it, but I think that's somewhat exaggerated in terms of the notion that it's going to lead to a consumer-led recession. But here's the good old leading economic indicator still indicating a recession. It's been doing that since the peak in December of 2021. The coincident indicators, meanwhile, keeps going up to a new record high. Actually, it was a pretty strong indicator. In July, it was up 0.4%, which is pretty good. This is one of the components that's sort of in the indicator. Payroll employment is in there, and this is total hours worked, an all-time record high in billions of dollars. It was sort of stalling out here, but it's now back at a record high. So that's good for the labor market news. Meanwhile, aggregate weekly hours of manufacturing upticked by 0.2%. You need a magnifying glass to see it, but at least it suggests that industrial production isn't going down. It may be flat to up a little bit. And industrial production is a coincident economic indicator. Housing permits are a leading economic indicator. Housing starts had a nice little rebound here, but that rolling recovery, if you will, following this rolling recession in housing, is probably not going to last very long here. We know that building permits are kind of flattening out here in July for single family. We'll see if that continues to be the case. But we know that multifamily permits are actually down. Maybe it's bank lending terms or credit terms are getting tighter. Maybe it's just the rent inflation's come down a lot and they're reevaluating whether it makes sense to build more multifamily. Here's rent inflation, as you can see, on current leases. So that's come down a lot, especially the apartment lease list is down to minus 0.7%. That's where we're likely to see the CPI rent inflation coming down, but it's coming down pretty slowly. But here's single family housing starts versus the component in real GDP that reflects residential. So that's a very important indicator. And this weekly indicator of mortgage applications for new purchases sort of stabilized here when we had this little rolling recovery in housing, but now it's turned right back down, and it's the lowest it's been since the mid 1990s. So the housing outlook looks like it's not going to be contributing to real GDP in the fourth quarter, after probably providing a boost in the third quarter. Meanwhile, capital spending looks sort of lackluster. Here's the CEO outlook index relative to real capital spending, and you can see that they're correlated. They're not kind of recession levels, but they're lackluster is the right term. This looks pretty good. This is nominal and non-defense capital goods orders, excluding aircraft. It's kind of flattened out at a record high, so that's okay. However, inflation adjusted, it's not looking so good. This is industrial production of business equipment, kind of confirming what we just saw in real orders. It's been on the weak side, maybe starting to pick up a little bit. But look, the round table includes, I don't know if Jamie Dimon still is the chair of the round table of CEOs, but he certainly was. He's still a member, and he certainly spent a lot of time scaring a lot of CEOs about a recession coming. So he's probably influenced some of their thinking about capital spending. These are regional indicators for capital spending, not looking too hot, not terrible, but not too hot. On the other hand, we do have this private construction of manufacturing facilities, very strong. That's the onshoring that's going on and the incentives provided by the government to onshore, particularly technology, semiconductor plants. Move on a little bit further here. Oh, how about this consumer? The consumer still looks pretty good, certainly in the third quarter. We know that employment's been strong. We know that wages have been rising faster than prices, or real wages have been pretty good. But how about this excess savings ID? Well, I don't know. I mean, people saved a lot during the pandemic, and now they're saving a lot less now that they feel more comfortable that the pandemic is over. I hope it's over, though the president's wife just got it. But COVID, that is. So the question is this going to suddenly go back up because people have basically taken their excess saving and eaten into it because they've reduced their savings? I just doesn't really make much sense to me. Again, this is the savings rate, same kind of idea. So the people who think the consumer is going to retrench, saying that, look, even if employment and real wages continue to go up, the personal savings rate is going to go up. And so that's going to mean that a good chunk of disposable income will be saved rather than consumed. And that'll cause a consumer-led recession, which then leads to employment losses and so on. I'm not buying that story, partly because of this story. This is net worth of all households. It also shows it by percentiles. But look at the net worth of all households. It's absolutely soared. Something like $35 trillion since the pandemic. It's a pretty steep slope compared to the slopes we've had in the past. And it suggests that people really did accumulate a lot of net worth, stocks, real estate. I was going to say bonds, but that's obviously not the case. There's a lot of money sitting in money markets and demand deposits. And so people did accumulate a lot of wealth. And just because their savings rate came down didn't mean that their net worth came down. They just accumulated net worth at a slower pace. This was the stock market going down. This is the stock market going back up. So I don't see that there's any compelling reason to believe that the savings rate is suddenly going to take a shot to the upside. And even if it does, it's not going to be a straight up shot. It's going to be a gradual increase. There's no particular reason why we're all going to, at the same time, conclude that, oh, we're running out of excess savings, time to save more. So that's it in a quick roundup. Again, this is pre-recorded on September 6th in the morning. My bags are packed, going off with my wife to Scandinavia. Looking forward to it, but certainly we'll be keeping in touch with what's going on in our financial markets that are relevant to all of us. Have a good week, and worry, but stay happy. Thank you.